Hey everyone, welcome to another video on my channel. My name is Saket, and today in this video, we are going to focus on simplicity of strategies. So there are a lot of strategies which you can use and execute. Each strategy will be giving its particular return. It has its own associated risk and so on. So today we will try to build a most basic and a fundamental strategy in Sensex, which is surprisingly working really well in the today's market. Not just today, it has worked well across the period of time, and I will be sharing the same. In this video, I'll also show you the logic behind building the strategy, the risk associated with the strategy, how you can backtest the strategy, and end of the day, how you can automate the complete strategy. So we'll be going step by step, and I'm pretty sure stick on till the end because what you're going to see is definitely going to surprise you. One very important thing that I would like to tell you is whenever we are discussing strategies, the most important thing to note is that every single strategy is associated with its own risk. So nothing is going to be risk free, everything is going to be risky, and it is very important for you to understand the kind of risk the strategy is having. And try to do your own research, try to consult your financial advisor, and only then trade upon these frameworks. So these are not just strategies, these are more like frameworks where you can tweak the necessary parameters and try to improve the performance. With this, let's try to move on to the video, before which I would also like to tell you that in case if you like such systematic trading videos, do hit the like button and subscribe to my channel. And if you want to learn more about how to trade systematically, not just options, but also equities, we do have a program called as the Learning Path. It is a 2-day program which is completely offline, where we'll be personally helping you to build a system to your needs and automate it completely. It is not just options, it is both options as well as equities in a way that you can systematically and consistently outperform the market. In case if you are interested to know more, make sure you visit the link in the description below and enroll for the workshop. So with this, let's quickly move on to the video. So before building the strategy, first we have to try to understand how exactly we can make the strategy simple. As I told you, so the core of this video is to ensure that we automate a very simple strategy. So generally when you look at it, most of the option sellers who are here in the market look for anywhere around 1 to 2% with a significantly lower risk, and they also generally end up pledging their investments and they trade on the pledge margin. So if your equities is, for example, giving you anywhere around 12 to 15% per year, it will be great if you can make additional 1% or 1 to 2% per month on this particular portfolio. So earning this 1 to 2% will actually help them boost their portfolio returns significantly. So somewhere people who are generating around 12 to 15% on their portfolio, which is sub 20%, can try to achieve to get somewhere upwards of 20% with end-to-end automation, right? So now how can we do it in a way where it need not be active? So the first one is we want to do it in a very passive way where we don't have to keep on looking at the market every now and then. So it should be done in a passive way. Second one, it should not have a lot of orders. So less orders, so maybe somewhere close to around just 8 to 10 orders per week. So generally what happens when you say option trading, so it is viewed as where you sit in front of the screen and punch a lot of orders. But the real money is actually made in waiting, not in actively trading, right? So the essence of what we are trying to build today has to be something very passive, and it has to have very less orders. So this is not percentage, sorry, this is orders. So it will have somewhere around 8 to 10 orders per week, and it is going to be a very passive strategy which can actually help to complement our portfolio. So what do I mean by complement our portfolio? So generally what happens, if the market is going up, so our portfolio will tend to perform well, because as and when the market goes up, even the stocks are going to go up. So our real trouble comes only when the stock actually starts to come down. So as long as it's going up, there is no issues. So the day when the market comes down, and if we also get hit from options, that is when we are going to lose double the amount. So we are going to lose both on options and we are going to lose both on equities. So we are going to build a strategy in a way where during the bearish market, it is going to reward us much more. In a bullish market, we might end up losing some money. in the range bound to bullish market or range bound to bearish market, we end up making a lot of money. So essentially, we want to build a strategy in a way where it mostly complements the portfolio. Whenever the portfolio is underperforming, we want to outperform with options, and whenever portfolio is outperforming, we are okay to give some money back to the market. So these three are the main characteristics of the strategy. It is a passive strategy, which means you don't have to actively participate or actively hit orders. The second one is we are going to focus on as little orders as possible. And finally, the third one is we want to focus in a way where it can complement our portfolio. So when our portfolio is performing, it is okay to give up some money because we want to make most of it when our portfolio is not performing. So with that being said, let's now go to step by step of understanding how to create this strategy, right? So the first one comes with entry. So here we are going to do a positional Sensex strategy. So why is it positional? Because we don't want to enter again and again. So we don't want to trade actively coming up in the morning every day punching orders. That is not required. So it is going to be a simple positional strategy on Sensex. Why Sensex? Simply because we are going to have much higher premiums on Sensex, and that is one of the reasons why I would be picking Sensex. So entry is basically positional Sensex strategy. So we can do a weekly Sensex strategy where every Wednesday, so now since the expiry has changed, it would be every Friday. So that is 4 DTE every Friday. You will actually end up entering 1500 rupee away call, 1500 rupee away put option, or 1500 points away put option, right? So assuming market is trading somewhere around 80,000, you want to go to 81,500 and you want to go to 78,500. So let me break it down for you. Assuming Friday morning, so let's pick a time of 9:30, right? So every Friday morning 9:30, you are going to come and see where the Sensex is. Assuming that Sensex is around 80,000 points or value of 80,000, so you are going to go 1,500 points away, which is at 81,500, and you are going to go 1,500 points below, which is at 79 or 78,500. So I'm going to sell a 78,500 put, and I'm going to sell a 81,500 call. So here, as I already told you, so we want to go something more bearish. So we want to complement our portfolio. How can we go bearish? Simply, I'll be shorting two quantities of call for every one quantity of put. So I'll be shorting two quantities of call and one quantity of put. So I am always bearish on the strategy. The reason why I want to go bearish is that I want to complement the strategy with my portfolio. So broadly, this is going to be my entry. So it is going to be a positional Sensex selling strategy where I'm going to enter on Friday 9:30 a.m. So one very important thing to understand is when you're building a framework, it doesn't matter if you're entering at 9:30, 9:40, 9:50 or 10:30. So you have to build a framework in a way where it is going to suit all the time frames. So since this is a positional strategy, it is okay to enter at 9:30, okay to enter at 9:40, or even okay to enter at 10 o'clock. So as per the strategy, so we will come on Friday, which is 4 DTE to Sensex, and at 9:30 we will end up buying a 1500 point away call option, selling a 1500 point away put option. So after doing that, now it is time to place a stop loss. And as I told you, it is going to be a very simple strategy. I am not going to complicate it a lot, but what I'm going to show you is how you can actually end up making some decent return with the same with very limited risk, right? So second one is how do you manage risk. So let's only focus on two things: how to enter, how to manage risk. So exit is going to take place automatically on the expiry day, so no need to exit manually. So how can I manage risk? Very simple again. So now I will just enter my positions. So position number 1 is 1500 points away call. Position number 2, another 1500 points away call. And position number 3 is 1500 points away put. So broadly, I have 3 legs. So that is 1500 point away call, 2 lots, and 1500 points away put. So what I will do here is I will keep a broad stop loss for all of it, just so that if the market is range bound, I will end up making money. If the market is bearish, then it is okay to get hit with one of the puts. And if the market is bullish, my portfolio is going to compensate overall. So this is a simple strategy where I am going to place 100% stop loss on both these legs, both call and the put leg. So I'm going to place 100% stop loss. So what is 100% stop loss? If I am selling this call at 100 rupees, then I have to place 100% stop loss, which will come to 100 plus 100 rupees, which is going to be 200 rupees. So even in this case, if I am selling the put at 120 rupees, 100% stop loss will come out to be around 240 rupees. So for one leg of call and one leg of put, I'm going to place 100% stop loss. So then we are left with another call leg for which I'm going to place a slightly higher stop loss, higher than this. So what I'm going to place, maybe somewhere around 150% stop loss. That means if my sell order is at 100, then I'm going to place a stop loss at 150% higher, which is going to be 150 points, which is going to be 250 rupees. So broadly what I am doing here is I am shorting two lots of calls. For one lot of call, I am placing double the stop loss. For one more lot of call, I am placing slightly higher than that is at 150%. And for the other lot of put, again, I am placing double the stop loss. So broadly, what is my aim here? If the market is range bound, then all three legs will make money. If the market is bearish, so then I am only going to get hit with one lot of put, whereas two lots of calls are actually going to give me money. And finally, if the market is going to go up, I'm going to get hit with both my calls, where this one leg of put will compensate for one leg of call, and the other leg of call will generally get compensated with the portfolio. So broadly, you are going to come on a Friday. So around 9:30 a.m., you're going to sell 1,500 point away call option 2 lots, 1,500 points away put option 1 lot. You are going to place 100% stop loss on your first call option, 150% stop loss on your second call option, and 100% stop loss on your put option. So a simple positional strategy trade where the entry is 4DTE. So looks very simple, sounds very simple. Let us see if this strategy is going to work. So one very important thing to note is to understand the risk factors associated with the same. So you should make note that each and everything you do has its own risk associated, and let us try to discuss about the same now. So we are going to build a strategy, backtest and automate with the platform Fintarget. So Fintarget is an automation platform which is free to use with the broker Firststock. So Firststock, you might have already heard about it in my previous video, is a new age tech broker which has really advanced features like your strategy builder watch list, and you can also do your in-depth analysis of your portfolio. You can adjust your portfolio straight from your position book and much more. All these things with Fintarget absolutely free to use is available if you have a Firststock account. To do that, all you have to do is open the account in Firststock using the link in the description below. I have attached the Firststock account opening link, so you can simply click on it, open your account and get 2000 rupees worth free brokerage credit straight to your account. Make sure you don't miss it out. Check out Firststock today by clicking on the link in the description. So here to automate our trades, we'll be using this platform called as Fintarget. So you might have already heard about it earlier. So I am going to log into Fintarget. Fintarget is absolutely free to use. Fintarget is absolutely free to sign up. So you can sign up on Fintarget by giving basic details. And this is going to be your landing screen of Fintarget. So Fintarget also lets you do paper trading or forward testing. And you can also do live execution on Fintarget. So here what we are going to do, from our home dashboard, we are going to come to the strategy page. So in the strategy page, I will end up creating a new strategy. So this is going to be a positional strategy. I will name it Sensex positional. So we are going to enter at 9:30 and we are going to do it days before expiry. So it is a weekly positional option. So I'm going to execute 4 days before expiry and close it on the expiry day. So in case if you find it difficult to follow how exactly I'm building a strategy, so no issues. I will also share a link. You can directly click on it and open the strategy right away. So Essentially, I have done a positional trade where I'm entering 4 DT and exiting on 0 DT. So first I'll change it to Sensex. Then we are going to sell a call option which is around 1500 points away. 2 lots. So I'm going to add it 2 times. And then we are going to sell a put option which is 1500 points away or 15 TM. So this I'm going to add 1 lot. So here initially we'll start by placing a stop loss. I'll place 100% stop loss on my first call option, 150% stop loss on my second call option, and again 100% stop loss on my put option. A simple strategy, no complications. So the idea is with having a portfolio in mind, you want to have something on the bearish side to complement the portfolio, right? And very simple strategy, no complications at all, easy to execute, hardly 6 to 8 orders per week, not more than that. And the and most importantly, a passive strategy where you don't have to actively keep looking at the market. So I'll name it Sensex Positional Simple, right? So let's save the strategy. So here, as soon as I save the strategy, so you can see Sensex Positional Simple. So this has been saved onto my custom watch list, and this would also be auto deployed. So you can see it right over here. So now I can choose to deploy this strategy as a paper trade. So forward test it and see how it is working, or I can deploy it directly onto the broker. So before deploying, it is important for us to backtest, see how it has performed, see what are the risk factors. So to do that, I can simply click on the strategy name and click on backtest. So whenever you buy the Fintarget subscription, so you're automatically going to get even the Stockmock credits which you can use to backtest. One more thing which I would like to tell you is the coming weekend, we are also going to have a free webinar on Fintarget where we are going to teach more such strategies. In case if you're interested, don't forget to register to the webinar right away. Again, the link for the same is put in the description. Make sure you check it out. It's absolutely free. We are going to discuss the strategies and we are going to show you how you can automate using Fintarget. So now let me just click on backtest and you can see the whole strategy is now created on Stockmock, right? So as you can see, it's 1500 points away call sell, which is 2 lots. One is having 100% SL, other one is having 150% SL. So then we have a put short. So it's a 4 DTE strategy, very simple one. And let me backtest for the last 2 years. So we'll see how it has worked and how we can use it to complement our portfolio. So once I come down right over here, so you can see the statistics of this particular strategy. So broadly, when you look at it, so this is the margin required and this is the overall profit that you have made in the last 2 years. So on an average, this strategy has generated around 1.8% return with a maximum drawdown of 7.42%. So that is the maximum drawdown for this particular strategy. So if you take a look at it, broadly, you have an average win and average loss, which is equal. So whenever you are making a profit, you're making somewhere around 4,100 rupees. And whenever you're making a loss, you're making around 3,600 rupees. So both of them are almost one and the same. But where you actually make the difference is with your probability. As you can see, you have a winning probability of around 70% against a losing probability of just around 30%. So the maximum drawdown days was just for around 93 days. So which is very easy to hold. So it will be lesser than 3 months. And you can see your return to max drawdown and expectancy is almost 3 and 0.47. So again, one very important thing to note is it is better to use this with your portfolio side by side because this is going to work well in a range bound and a bearish market. So while we are backtesting, you can see the 2024 period was actually a bull market. So from 23 to almost September of 24, we were continuously in the bull market. And as you can see here, things, especially during this time, the strategy has done fairly well. And in the bear market, as you can see here, so the strategy has outperformed. So December, January, February were actually the bear markets where the strategy has outperformed quite a bit. So again, you just compare this alongside your portfolio. So this would be the period when you would have got hit the most. So January, February and December. So that is the same period when this strategy would have given you good profit. Along with that, you can also see periods like July, August, September, October. July, August, September specifically were the periods of bull run. So there you have actually lost some money. So November, I think it would be some case specific event. I think it would be because of the Trump election rally. So where the markets rallied quite a bit. So that would be one of the results where we might have lost with a big gap up or a gap down. So April again, we would have lost with a big gap up or a gap down due to the tariff issues. So there was a big 4% gap down, so which we might have gotten hit. So broadly, when you look at it, you can also see the equity curve of the strategy, how exactly it would have performed over time. So it starts somewhere around December 23, and you can see consistently the overall equity curve has gone up. You can further come down and see day wise or week wise P&L, how much you would have made or lost. So broadly, this is overall how the strategy has performed. A fairly simple one, but please try to understand the risk associated with the same. Consult your financial advisor or do your own research before investing. So this can be easily automated on Fintarget, and all you have to do for the same is just go to your home screen. Since you have already saved the strategy, you can hit on a run on a Friday with a paper mode where you can forward test the strategy. In case if you want to automate right away, you can just change it to the broker and you can start automating it. So I will also share this strategy with you. So I'll go to the strategy section and I'll also share the strategy with you. So you can just click on the link and the entire strategy will be created and you can start using it. So make sure you create your free account on Fintarget, and if you have and if you want to use a new age broker, which is very tech friendly, you can check out First Talk. So if you want to learn more such strategies, you can also enroll for the free webinar which they are conducting. And finally, if you want to learn more about this in a systematic way, so you can also enroll for the workshop, which is Learning Path. So I hope this video was informative. This video was useful. So what I would definitely want you to do is combine this with your Nifty returns or combine this with your portfolio returns. See side by side how this would have complemented your portfolio when it is not performing and how this will get affected when your portfolio is outperforming. So with this, we also come to the end of this video. If you have found this video valuable, make sure to hit the like button, share this video and subscribe to my channel. Thank you so much for joining, guys, and see you soon in the next one.